Can we expect the interest rates to come back to 3 to 4% in the future?
In your lifetime, yes. Ask me when.
Anytime soon,
No, ask me when.
the next 5 to 10 years.
Maybe.
Okay.
So it's market timing, interest rate timing is nothing that any one individual can do. Investing is driven, even the stock market, it's driven by sentiment, right? We have all this historic data. We have all these price points. We can track everything for 80 years, but it's still people, and people make decisions, and people don't always make rash decisions. So interest rates is one of those things that, we try to look into the crystal ball and project. But in my lifetime, the Fed funds rate has been 2 and it has been 18.
Well,
So there's the range in my lifetime of what it is. So when we look at today's rates which are above 6%, and people say, "Oh my gosh, it's 3 times what it was." Well, yeah, but as compared to, so it's where we live, right? In this frame in time, interest rates are higher than they were over the last 8 to 10 years, and they'll also likely go up, and then they'll come down. And the real issue with interest rates with respect to real estate is that interest rates affect the value of real estate, because if you have to pay more for money, you can afford only so much less real estate.
right.
As interest rates go up, you can afford to buy less real estate. So that's the gist. So that slows the market, right? As interest rates go up, people are required to have more cash just to get to a manageable debt service coverage, just to get to a manageable mortgage payment for their family. So when interest rates come down, people have more flexibility, they have more buying power. And as interest rates increase, there's less flexibility because more cash is required. And cash is a hard thing to come by, right?
Right.
It doesn't just materialize, it requires savings, it requires being studious, it requires time to collect cash. So if people need longer to collect cash, that's less time they have in the market actually buying real estate. And I'm not talking about the billionaires that can write a check, or an investor that's parking money in real estate, because that's what some people do, particularly in California, right, where 1 out of 3 homes is selling for over $1 million. If people are just writing a $900,000 check to buy that house, they're probably not living in it. They're renting it for X, and they're okay with their return on the money, whether it's 2, 3, or 4%. It's just diversification for them. But then there's us regular people, right? Those folks that have to have a place to live, that are looking for an investment property, whether it's a duplex or a 24-unit building. And interest rates dramatically affect our decision making and our capacity to identify and view what's in the market that's available to us,
Right.
because we only have so much cash and because interest rates are so much. So what happens in that environment? What happens is people start using variable rate loans, right? Because they get a break on the interest rate in exchange for taking more risk on the interest rate side. So when you get a variable loan, if you get a fixed rate loan that's fixed for 30 years, you know exactly what your interest rate is for the entire term. If you buy as a consumer, if you buy, what I mean by buy is if you agree to a mortgage that has a variable rate, you get a lower intro rate, but you have more market exposure. If interest rates go up, your rate's also going to increase.
Mm,
So people, why do people do that? They do that because it gives them more flexibility on the initiation, on the initial purchase. And
right.
then what do people do? They hope. They hope interest rates don't go up anymore, or they hope interest rates come down so that they can buy into or get into a fixed rate.
Yeah.
So interest rates
Sean,
have,
do you recommend people to use variable rate loans in certain circumstances, or is that something that you're, totally against?
I always recommend a fixed rate over variable for homeowners, because you know what your cost of living is, excuse me, your cost of money is.
Right.
And if it's your home and you're going to be there forever, forever can be 5 years,
Yeah.
then you don't have to worry about what happens in the marketplace with respect to interest rates. Variable rate loans are more risky. So using a variable rate loan just means you need to be aware of that risk. on the front end, and don't guess and don't discount it and don't presume it won't happen to me, because all of those things will happen to you at the very worst time. Right when you lose your job, interest rates will double. I mean, it's just, there's no way to control those things, right? There's just no way. So variable rates just have a higher level of risk. So use them with caution, preferably on a short-term basis, short-term meaning 1 or 2 years, and get into a fixed rate as soon as you can.
Yeah, that's a good point there too. For people that didn't know, you can get from a variable rate loan into a fixed rate once you already, signed off on the loan, right? So
Right. Yeah.
thanks, John. Appreciate it.
Can I take that a little bit further?
Yeah, go ahead.
So let's say that you're looking to buy a small rental property and you have the 25% cash down, but the only way you can get the property you want is with a variable loan. So if you're buying the property with a variable loan, as I just shared, there's more risk, right?
Right.
That said, once you own the property, you have the ability to potentially raise rents, reposition the property, increase the revenue over a year or two. I'm not saying it's going to happen in a month or two, but over a year or two, you have some turnover, you do some renovations, you raise rents just to market. I'm not suggesting anything that's going to skyrocket. But if your revenue has increased 22% in those 2 years, then you likely have a more valuable asset, right? So you'll have created some equity, which would put you in a better position to go out there and gain that fixed rate mortgage and get away from that variable rate mortgage.
Right. Thanks for sharing that, John.